Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today we're doing a deep dive into Qualcomm, ticker QCOM. What they just did, well, it feels less like a simple business pivot and more like a declaration of war against the AI giants. And yeah, this is all based on our research, current as of today, October 28th, 2025. The big picture, the macro stuff, it matters, obviously. Pre-market futures, pretty flat. Kind of a shrug emoji morning. Plus, you've got Moody's warning, right? Saying nearly a third of the U.S. economy is flirting with recession. California, New York, basically treading water. So that consumer conference report coming up is pretty important. But honestly, QCOM's news yesterday, it just blasted right through all that background noise.
Oh, absolutely. It was a strategic declaration of war. Like you said, they unveiled these new chips, and they're aiming squarely at the AI data center market. We're talking NVIDIA and AMD's territory here. This wasn't just, tweaking things. It's a fundamental shift.
And the market reaction.
Immediate.
Stock shot up over 11%.
Huge move.
And the proof this is real, not just talk, it came right away. This big partnership announcement with Humane, Saudi Arabia's AI firm.
Right. And that partnership, it gives this whole pivot immediate teeth. You're talking large-scale capital access, a key market entry point. It really speeds up their whole data center game plan.
Okay, but here's what I'm trying to wrap my head around. The market clearly loved it. Institutional money piled in, driving that 11% pop. So why are more than half, 53% of Wall Street analysts still sitting on the sidelines with a hold rating?
Yeah, that's the core conflict, isn't it? Are they being too cautious, or is there a risk we're overlooking?
What are you seeing?
Well, you really see this tension in our fair value models. Look, the cash flow model. It suggests the stock is way undervalued, maybe around $233. That model is basically buying into the future promise, assuming these new AI chips get adopted, big time.
Okay, that's the bull case.
Exactly. But then you look at the earnings model. And that one puts the value much closer to where it's trading now, like $188. Why? Because it's anchored in QCOM's history, their established mobile business, which is, frankly, slower growth.
So the analysts are kind of stuck looking backward while the market's betting on what's next.
That's a good way to put it. They're looking at the company QCOM was, not the one it might become.
But despite those hesitant analysts, you look at the sentiment data. The crowd seems to have made up its mind. High conviction, right?
Oh, it's screaming high conviction. Short sellers, practically non-existent. Short interest is super low, like under 3 days to cover. Nobody wants to bet against this right now.
And the options market tells the same story.
Absolutely. The put-to-call ratio is just 0.36. That means for every one bearish bet, there are nearly 3 bullish ones. And where's the action concentrated?
Yeah.
Right around that $180 strike price for calls.
Wow. Okay, let's talk charts. The move yesterday, it was like a rocket launch, a really violent, decisive breakout.
Massive volume, too.
Totally. Opened near $169, ran all the way up near $216 intraday, and still closed strong at $187.68. That wasn't retail, that was big money pushing it.
Definitely institutional buying.
So technically, the trends, short-term, long-term, they're pointing straight up now. Powerful uptrend confirmed. But
yeah,
there's always a but, isn't there? That kind of explosive move often comes with warning signs.
Right, and we're seeing one. A key momentum gauge, the RSI, the 14-day relative strength index.
Yeah.
It's flashing overbought, clearly.
So maybe a pullback is needed.
Well, it suggests things got maybe a little too hot too fast, and because the move was so sharp, expect volatility to stay pretty high while it finds its footing.
Okay, so let's try to pull this all together. We've got the cautious macro backdrop, but then you have this incredibly bullish sentiment, this huge strategic shift, and this fundamental split between the past and the future potential. What's the final verdict?
Based on everything, our outlook is cautiously bullish.
Cautiously bullish, okay.
The bullish case is strong, but you have to acknowledge the risks. First, yeah, the broader recession fears are still out there. That could trigger profit taking, especially after such a big run-up. Second, technically it is overextended short-term. It's vulnerable to a pullback just to consolidate those gains.
Makes sense.
And third, you still have the majority of Wall Street analysts playing catch-up. Until they start upgrading, that might act as a bit of a ceiling.
Right. So the key levels, the battlegrounds for the next few sessions, where should people be watching?
Okay, critical zone. The bulls must defend the area it just broke out of. Think between $180 and $187. That needs to hold.
It holds.
If they hold that ground, then absolutely. A retest of that intraday high near $206 is definitely in the cards.
And the downside risk, when does the bullish idea break?
The immediate bullish thesis really only gets invalidated if it breaks down below $174. That would be a significant failure to hold the breakout.
Got it. So Qualcomm's fired. It's a big shot in the AI wars. It's a major pivot. Now, the question is, can they hold the territory they just took? That's all for this deep dive. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.